Good morning, everyone. Welcome to this update for global stocks and commodities for the 26th of May. It was a pretty volatile week all around the world with lots of events going on in obviously the US, and you got Brexit in the UK, and in Australia we had the election result, which certainly dictated the movement of the Australian market. And there was a lot of movement of price during the week, but net over the week, not so much. So there was lots of ups and downs, but markets managed to hold reasonably steady. So let's jump in this update. I want to look at, I guess, the most important thing, and that is we've gone from a period of strength with the first 4 months of this year, and we're now going into a period of 4 to 6 months when markets can be a bit weaker, and there's certainly enough reasons why they might be volatile in the next few months. None more so than the Chinese and US dispute, which is certainly becoming obvious now that it's a lot more than just about trade. This is about global dominance, economic, military dominance. It's about ideology, and therefore it's not going to be resolved anytime soon. So I think this is the sort of environment we're going to be in now for quite some time. As normal, markets will get bored with the volatility. They'll get bored with the constant tension of the moment, and I think this issue between the US and China will grind on for many years to come, and markets will eventually just start to gradually divert their attention elsewhere, and it'll become less important. But there are, to my mind, there are three main themes that are really important in this sort of environment. So I want to touch on those briefly, which I'll do at the end. There's a normal stock and commodity trend update and portfolio analyst last week. Amongst a number of questions from members, I did look at the Australian high growth stocks, the high PE, ultra high PE technology stocks, and where the opportunities and where the pitfalls are in those. So let's look at the action from last week. The S&P ended up losing 33 points on the week, but it remains within the 5% pullback, garden variety type of retracement that I talked about last week. So far, this is playing out pretty much as I would have expected. It's got more volatile on a day-to-day basis. We're getting much bigger swings on a daily basis, but we're getting a day or two of down followed by a day or two of up, and so net we're not really going anywhere much. The short-term price action is very much about perceptions, people trying to anticipate what comes next, and therefore that is swinging sentiment around quite wildly. And if Trump tweets something, or the White House makes an announcement, or China says something, then that is having an outsized effect on markets, far more so than it should be. But that's just the way it is these days. But the medium and longer term will always be driven by the economic fundamentals. At the end of the day, that's what drives the market. And the position that the US is in at the moment is reasonably solid. The economy is good enough, the earnings are good enough, the interest rates are low, equities are still the most attractive asset class, and that's really all you need to know about the medium to longer term. Now, the US dollar was down slightly last week, gave up a bit of ground in the last couple of days, and the 10-year Treasury yield is now down to 2.32, so it's dropped from 3.3 not that long ago, seemingly heading for 4, and now we're back to the low 2% area again. And the 30-year yield, I noticed, down to about 2.7. So that means if you lent your money to the US government for 30 years and redeemed at the end of the time, then you would have accumulated the princely sum of 2.7% per annum, which for most people's purposes is just not going to cut it. And that's why there's a lot more risk being taken in other asset classes. So let's jump in and take a look at some of the charts. This is the S&P. We'll start with a monthly chart. So this is the very big picture. So to put it in perspective, this is the bottom of the GFC just here. And you can see we've definitely got a lot more volatile since around about February of 2018. But the market is still holding up reasonably well, and we are still in a big picture uptrend. I think that's the message from that chart. Sorry, clicked on the wrong button. There we go. So this is the S&P now on a daily basis. I've talked about the fact that I didn't think the circumstances were such that we get any more than a 5% pullback, and a 5% pullback brings you down to about here. So that's the what a 5% pullback area looks like, and we're still managing to hold within that. And as you can see, there's plenty of gaps, there's plenty of big range candles. I'll just take that off again so you can see it more clearly. But we're just sort of bouncing around within that zone. So that is the S&P. Now, I'm not saying that it's not possible that this will break out and we get a bigger pullback. That is indeed possible. I just think on what we can see at the moment, that is quite an unlikely event, but it is still possible. Now, the Nasdaq has been experiencing a bit more volatile conditions because obviously there's a lot of high PE stocks and technology stocks that are tied to trade with China. So they're getting whacked around a little bit, particularly the semiconductor area. So naturally the Nasdaq has been a bit more volatile, but it's still holding well above its 200-day moving average. That's the key point. And if we look at the triple Q, which is the sorry, not the triple Q, IWM, which is the Russell. So the Russell for small caps, you can see small caps are certainly well off the August highs. So we've not got back and formed new highs as we did with the other bigger indices, which is not unusual, and it is looking a little weaker. So I'm watching the small caps quite closely. You can see that the 200-day has clearly rolled over now. The price traded below it for some time, but has managed to get back above it again since around about February. It's just borderline at the moment. So this is a pretty important area for the small caps in the US. Now we'll look at the currencies. So this is the US dollar. So we've just got a continuation of this quite mild uptrend that has been happening over recent months. So we had a huge bounce that occurred in 2018, and then since then we've just been on this sort of mild uptrend towards the 100 mark again. And the Australian dollar, of course, broke down a couple of weeks ago. We got a bit of a bounce last week, which was partially about the US dollar going down, but also because iron ore went over $100 as well. So that's sort of boosting the Australian dollar. But as you'll see on the next slide, there's certainly now pretty much consensus that the RBA is going to be cutting at least twice this year and possibly even more. So moving to Aussie stocks, we ended up trading at 69.33, and that was in part the correlation with the US dollar. Certainly the RBA has now pretty much said that they're going to be cutting rates in June. They said they're going to look at it in June. I think that probably means they're going to do it. And Westpac, who Bill Evans from Westpac, I think is probably the most highly respected and most accurate currency caller in Australia over a long period of time. And he's now saying 3 rate cuts in 2019, which would take us down to 0.75. So for all those of you with a variable mortgage, it's pretty good news. The ASX 200 ended up rising 90 points on the week. So as I indicated last Sunday after the election, that I thought there would be a sugar hit to the ASX, and indeed there was. So there'd been a lot of pressure on stocks that were going to be affected by a Labor victory. That included bank stocks. It included stocks involved in mortgage financing. mortgage insurance. It included building stocks. It went very broadly across the economy. And of course, when Labor didn't win, then all that that discount that had been put into those share prices came back out again. Now, I think there is an element of short squeeze went on in the Australian market. The rise, particularly in the banks, was so meteoric on Monday. Most of the banks were up 7 and 8%. That was more than just a removal of the discount. That was a big reversal and the short squeeze playing out. So therefore, I'm not getting terribly excited about the most of the top 100 sectors again at this point in time. However, just for the record, the index achieved its highest level since 2007, as we'll see in a minute. But I still think that a lot of the top 100 that are heavily entwined with the Australian economy are still at risk. And you've got to remember that Morrison has won for various reasons that have been well canvassed, but nevertheless we have an economy that has some significant structural challenges. The government that we've had over the last 3 years has been very ineffectual. I can only hope that now that there is now a more united cabinet and a more united team in terms of policy outlook, that we'll actually get a better performing government. Let's hope so for all of our sakes. But until that is proven, I still think that a lot of the top 100 stocks in Australia are at risk because I think our economy is still at risk. So let's take a look at the ASX. So there was a real surge, huge surge on Monday. And if we pan right back, you've got to go all the way back to here, which is November, December of 2007. So when we were still at basically the all-time highs. So that has been a surprisingly good performance. But as I said, I'm not getting overly excited that this uptrend is going to be sustainable. Now, while I'm here, let's look at gold. So this is the gold price on a weekly chart. You can see we had a little bit of a rise last week, but we've essentially just been holding this level now for about 6 or 8 weeks. So not a lot has happened with gold. If we looked at it on a daily basis, you can see that we've just really been going sideways now for some time. Not a lot of change there. Let's take a look at GDX. So GDX, again on a weekly chart, so this is big picture, hasn't really changed much at all. So just to confirm that, gold rose by $8 to $12.86, but we're still below the 1300 level. And that in itself tells you something about the fear level. It's just really just not there. We're getting a lot of volatility and a lot of bouncing around based on announcements and news. But there's not a level of fear, and I'm not seeing it in the options market that much either. The premiums have gone up a bit, but they haven't really gone up as much as they did at the end of last year or at the start of 2018. So that all translates to an Australian dollar gold price, which is extremely robust at $1,860. No wonder the Australian gold stocks are going so well. So GDX was steady, and whilst most of the Australian gold producers have been in uptrend for some time, and they've really they're in a period of consolidation now, there is a very promising emerging producer which I'll be reviewing in Portfolio Analyst this week. Other commodities, copper was down again to 268. And I think what's happening here is that speculators in the futures market are betting on a global slowdown because of the trade war. Now, that may or may not occur. I mean, who knows? There could be agreement reached, or a Clayton's agreement reached between US and China just to sort of calm the markets down. I don't believe a true resolution of this is going to happen anytime soon, but they could always, they could always come to some sort of agreements on trade issues. Crude oil was down sharply, very sharply, to 58.63, which is a combination of a number of factors, and clearly volatility has really picked up of late. This is going to set up some excellent buying in some of the majors, that's for sure. And just as an example, let's look at ExxonMobil, for instance. And this is a weekly chart of ExxonMobil, and every time on a weekly basis, this gets down to oversold. So here and here, you do get really quite decent bounces of somewhere between 15 and 25%. Now, there is a bit of an overall downtrend here, you can see, so we really need to overcome that. And we're probably not quite there yet. But I think if you're buying into quality stocks in like ExxonMobil in the energy sector, or the really quality stocks, Microsoft, for instance, in the tech sector, after a decent sell-off that goes on for several weeks or quite a few months, then to me that's a pretty low risk, high reward sort of strategy. So that it's just something to bear in mind. There's the spot copper chart, so you can see we've come off very sharply from $2.95, and now we're down under $2.70, so that's been quite a sharp move in copper. And equally, there's the big move in crude oil as well, from 66 down to 58. So some big moves there in commodities. Now to wrap it up, what's going to work best in all likelihood through this period, this US lull period that we're now entering? Traditionally this middle part of the year, which coincides with the major American school holidays, a lot of people go away, the trading volumes are down, and often the market will struggle to gain traction during this period. So what are the strategies that are going to work best through this period? Well, as I just indicated with ExxonMobil, just as one of many, I think if you buy quality stocks after meaningful pullbacks, then I think you're on a pretty good reward for risk equation there. And you could also consider some leveraged ETFs after larger corrections. And just as an example, this is TECL, which is an extremely volatile instrument, but it tracks the technology sector, which over the years has been unquestionably the strongest sector in the States. And with the outlook for everything to do with the internet and artificial intelligence and all those things, cloud computing, the technology sector is almost certainly going to continue to lead. Now that doesn't mean that it won't be subject to big pullbacks, and we certainly got one here. But look at the rebound once we do get the reversal. And there was a pretty clear reversal. You've got to remember this is a weekly chart. There's a very clear reversal here in the week around Christmas, which then led to the price rising from around about $80 and more than doubled. Now we're currently getting a pullback again, but I present this just as a, for those people that perhaps don't look more broadly at the possibilities in the market, there are some tremendous instruments if you've got a game plan and you've got a little bit of courage and you're pretty clear on what you're doing. Then there are some wonderful instruments where you can move the dial very significantly on the value of your account. So those sort of things is something I'm going to be ramping up also in Portfolio Analyst. The second area is Australian small and mid-cap growth stocks because they are largely independent of the global economy, so of the local economy. They've got global businesses, and they're also largely independent of macro events. Now, I've got a lot of these sort of stocks in my superannuation portfolio, and they have not little correlation, but they have remarkably minor correlation to macro events overseas. tend to move up and down according to their own story. And, that's pretty good in this sort of environment that's subject to such massive swing changes. And the third area, which may not appeal to too many people, but is certainly a terrific area, is writing option premium for regular income. Is an area that I think more people should look at, really, because it really does provide an attractive risk for reward outcome. Portfolio Analyst this week is really various means to how to play the big rebound if it sets up. Now, we're not set up for the big rebound yet because we haven't had the big downside. So you've got to get the big downside to get the big rebound, but there's no substitute for being prepared early for what may unfold. Because if you wait until you get to a position where the market has sold off heavily, then you're tending to make decisions based on emotion. And it's very hard to make clear-headed emotions at that time. So it's best to get clear in your mind what your plan will be for something that may set up in the future. So that'll be Portfolio Analyst this week. There's my contact details for those that aren't members of any of my services, and I look forward to being back with you next Sunday. Cheers.